everyone. Welcome to another episode of In Conversation by Advisor Coach. Today, in Conversation, we welcome our dear guest, Mr. Anunaya Kumar, once again. Anunaya Kumar is the President and Head of Sales and Distribution with 361 Asset Management. Welcome, Anunaya, to In Conversation once again.
Thank you, Soren. Happy to be part of the discussion once again. And you have always been picking interesting topic. I hope we can add value this time again.
Absolutely. So this time, Anunaya, in fact, the topic is very interesting. It's about SIPs, correct? So my straight question is that, SIPs have actually become a way of life, correct? And we have seen a major correction in the markets, in the Indian equity markets in the past couple of months. So literally, someone who started SIPs about a year ago, over a year ago, their returns have completely become negative in those SIPs. So what do you say to that?
So let's first understand what SIP is. I'll just spend maybe 30 seconds on that, which is nothing but a systematic investment plan, which is nothing but to be disciplined. And you decide an amount, you decide a tenor, and you decide a date.
Yeah.
In a very disciplined manner, it will go on its own. Now, the idea obviously is to see the compounding effect coming in, accumulate enough units, and through the units enough value of investments, and which eventually compounds and get to a certain value, which is what you look upon when you plan one of the goals. That's the basis. The markets normally will show you three kind of phases. One phase is the typical bull run. The markets are in a unilateral up move. Then you will have a time when the markets are in a range bound. And then you would see the market get into corrective mode. Now, SIP has its relevance in all the three phases. As you see the markets in the bull phase, which is just we have seen a couple of quarters behind, what it does is that every unit that you accumulate is actually helps you build the margin of safety. Because that's the way you are building the units and you are building the margin of safety. So hence, in a bull run, SIP has its relevance. Even if you feel that all my incremental units are coming at a higher cost, but in the process, you are also building the margin of units, safety for all the units that you have accumulated. In a range bound, it is largely accumulating units for the compounding impact. Whenever it would come, start showcasing. The problem comes up in the down market. On the market, when the markets are sliding or drawdown structures are visible, which is where you will see the people get edgy, all their commitment starts taking a backseat, and you would see multiple stoppages in the SIP happening. Now, why does it happen? It happens because the short-term phenomenon of losses, which are visible, and you just started off saying your 1 year SIPs are getting negative. But these are short-term phenomena. What it would do is somewhere it is going to cross and your losses start looking better, because what it does is you are actually accumulating units at a lower cost. And in the process, you are taking advantage of dollar cost averaging, which is where your per unit cost of accumulation of all those units actually comes down. And when the market rebounds, then all those accumulated units starts giving you compounding effect. So what people doesn't understand that the drawdown scenario of the market actually is the best time to have SIPs, because all your incremental units are actually coming at a lower cost.
Yes.
So then that's the time when you will see the real dollar cost averaging happening and a phenomenal compounding effect getting visible in your portfolio. So this is and the markets go through a cycle. Nothing is permanent. The only thing which is permanent is market is a dynamism, and you will see all the three structures: drawdown, range bound, and moving up.
Sure. So we also see that a lot of these investors who start seeing their returns in red when they start their SIPs, they kind of stop these SIPs. What suggestion or advice would you like to give such investors?
My only question to the gentleman or the lady or the investor is, why did you start an SIP? You had started an SIP because there was something in your mind, which is either to some goal in your mind. It could be kids' education, it could be retirement, it could be marriage, it could be health, whatever. None of these things which are you looking at is 1 year, 2 year away from you. Then you are getting edgy. You all have got 10, 15, 20 years, depending upon at what point of time you started an SIP in your career. Earlier is always better. If you have that bit of a time frame with you, then again, I'm going back to what I started off. These kind of markets are actually super good to you. because it is helping you accumulate units at a lower cost. And wait for a time, hold patience, wait for a time the market gets back, to the up move. Then all these units that you've accumulated at a lower cost is going to give you a benefit. The problem is, unfortunately, the way we look at other asset classes, gold, we look at real estate, we give a lot of time for the assets to prosper and then give you the kind of benefit that you are looking at. I don't know, when we look at a capital market, why all of a sudden we become such a short-sighted approach. We take it that we want to start looking at on a monthly, quarterly, and annual basis. Is it because it is too transparent? Is it because the informations available are so easily, and hence you are defying the very purpose of investment, which is to create a long-term wealth creation? So don't get perturbed. These are the great times. In fact, you should increase your SIPs if it permits in these kind of times, rather than stopping it.
Right. So a lot of herd mentality happens, because a lot of investors were making a lot of returns in the SMIDs as a section, right? And so a lot of people who didn't have the risk appetite to jump into SMIDs as an SIP category, but they did jump in because looking at the past historic performance, and that's what most of the average investors tend to do, right? So to your mind, I just want to pick that. Is there any perfect scheme where, or an asset category within those particular schemes, where an investor should primarily focus on a very long-term SIP?
See, ultimately, whichever scheme we talk about, you are talking about adventing into the capital market. Now, there can't be a thumb rule to it, because every avenue of investing, or every tool that you look at investing the funds, each of them have their own risk parameters attached. So if you are an elderly person, and for me to tell you to get into micro cap, again, it's a mismatch.
Of course.
So what I would, on the contrary, suggest you is to have a tenor in mind that you are looking at. Get your correct risk profiling done, and see to it how diversified you really would want to, or how much of your risk profile permits you to take the diversification. Because as you move away from the large caps, your ability to onboard risk also has to increase. It's a different story that as you get closer to the mid, small, tiny, with a higher element of volatility, the returns or expectations or the experiences are better. But it comes at a cost. The cost is the volatility. As you get closer to the large cap, the volatility elements are slightly subdued. So, number one is your risk appetite has to permit. And if you don't want to apply your mind, you simply want to say, man, I don't know, I simply want to go ahead. Flexi cap, the most diversified. Trust your manager. Let him take a call on how much of large, how much of mid, how much of small he wants to take. Trust your manager. If you are able to find a good manager, take a flexi cap. If you want to slightly lower your risk, take a large and mid. If you want to take a little bit of an equated approach, take a multi-cap, where 25 each of the asset class representation would happen.
Very true.
And if you say, boss, I'm very young, I have 30 years ahead of me, I have a very, very high risk appetite, take a mid-cap. Because there the volatility would be very high. And hence your dollar cost averaging also will have a very, very strong impact.
Absolutely.
So that's the function of what kind of risk appetite and what kind of risk profiling are you doing, and what is the tenor that you have in mind.
Sure.
Hence, it is very important that you must meet with your advisors.
So any data which represents this, Anunaya?
See, the data only tells you, if you look at today the SIP flows, the SIP money you would see largely in the flexi cap, mid cap. That's the space where you would see the highest element of SIP getting done. That's about it. Well, and obviously that would mean that you will have your own compoundings and all coming in, depending upon what kind of what have you taken up and what kind of risk are you taking in. But yeah, if you ask me, largely it is flexi and a mid, which is where the SIPs interests are pretty high.
Sure. And how much do step-up SIPs make sense for any investor coming in from a long-term investment horizon?
Yeah, I'll just share with you one screen, and that will help you understand how the step-ups help you. I hope I'm.
Yes, it is visible. Yes.
Yeah, just. So this is a classic case of a step up, that I'm assuming somebody who has come into the fund with a view of 25 years and looks at investing 10,000 rupees, uh, and assume that he takes up a 10% top ups. He steps up 10% every year as he starts getting into the wealth creation mode. On a 25 years, the investment obviously through the conventional approach is close to 30 odd lakhs. And if you look at step up, it is almost going to be 1.18 crores. And look at the corpus that you end up building towards the
Oh,
end.
there's a substantial difference we see there.
It's more than doubles. It's more than double. So step up has a very, and obviously I have taken a 12%. These are just a illustration.
Sure.
Just an illustration for someone to understand what kind of impact it can be. 12 can
So
be 10,
here
12
just
can
for
be
the
8.
viewers, we are looking at a 10% annual top up
Yeah.
in the SIPs. We're looking at 25 years and we're looking at a 12% annual CAGR. Is that what we're looking at?
Which is what it is. But the beauty is, if you see the curve is really moving upwards.
Absolutely.
If someone has the disposable income going up, a strong suggestion that you should look at top ups in the SIP.
This is very interesting.
Yeah, this has got strong merit.
And the corpus at the end of 25 years, there's a huge amount of differential as we can see in the screen.
Absolutely.
Interesting. Thanks for sharing this. So I think SIP top up definitely makes a lot of sense.
I completely agree. And that's what I said. It should be out of your disposable income. And to me, if you are in a growth stage in a career, for you to set aside 10% on the SIP commitment, I don't think it's too much of an ask. But what it will give you an experience after maybe 20, 25 years would be humongous.
And what I would also like to add to what you said is also that it's not about, the NAV performance, which will get you the profits and the wealth creation. It's also the accumulation of the units, because at the end of the day, it's accumulation of the units into the NAV, which will create your overall profitability and the wealth creation in the long term. Absolutely. So Anunay, so much about SIPs. SIPs has actually become a way of life, and every household is trying to invest. Of course, there's a long way to go. There's certainly a long way to go. Looking at unique PAN investors, just about 5.3 crore odd number what are investing in the overall, let's say around 70 crore odd PAN cards issued. So what and all the investors who've started, and we've also looked at a lot of these demat accounts which have opened almost about 17 to 18 crores. So there's definitely a lot more know-how about capital markets today. There's a lot more interest in the capital markets today what was 30 years ago, and it's become a lot more easier as well, because if someone is wanting to invest into capital markets, he just has to pick a good institution, a good fund manager, and start investing on a monthly basis, start making return. However, they do stop the SIPs as well, and that's how the data trend has shown as well. And hence we've seen the net SIP is only about 35 to 40 odd percent, because some SIPs are stopping or some SIPs are getting to maturity. So what good message would you like to give to investors and distributors here, about the SIPs as a real long-term investment journey?
See, the most important thing is when you look at stopping an SIP, you do carry a reinvestment risk, because that money was available to you. You have stopped it. What are you going to do with that money? That's very, very important, which people normally haven't understood. I'll simply give an example of our own fund. One of my focused equity fund, which has seen more than 10 years of a track record. Between the people who started investing in the fund in the month of, say, October of 2014, and had taken a 10,000 rupee SIP and kept on investing, and then somewhere in between 15 and 20, they kind of stopped it. They said, boss, we don't see anything happening, and they stopped the money. And some set of people who continued investing in the people who stopped in 2020, which I'm talking about, that COVID time, say 31st March of 2020, the return from 1st of Jan to 31st of March 2020 is close to 1.12% XIRR. Okay. And someone who stayed invested as on 17th of Feb 2025, the CAGR is 16%. What have you done? You have just missed those 5 years. You stopped it, you didn't continue, and that's where your returns all started, getting subdued. The point that I'm trying to make is ki you will, if you see the journey of last 10 to 12 odd years, I think anything that could have gone wrong in the for the market has happened. Anything that could have gone for the market has happened. Uh, but the beauty is, if I see immediate recent past, we had just made the highs in the capital market. So what have we really been able to achieve by trying to time it? Nothing. You might have felt that this is the best time to stop an SIP and you stopped it. But then you carry a reinvestment risk. Sometimes then when you restart it, you might be a case of a FOMO.
Mm-hmm.
You get your FOMO feeling so intense that you feel what have I missed out
Sure.
in between. So very clear message to the audience is set a goal in mind, define the tenor, build discipline, decide disposable income that you would want to contribute to an SIP. If your cash flow permits, take a top up and stay put.
Sure. Absolutely. So just one more minute of yours I'll take in one more additional question is that we often hear that someone's continuing on a long-term SIP model with some getting into large and mid cap and mid and small caps, but then they suddenly, the voices in the market start coming in that stop investing in a particular market sector and start an SIP in a particular sector. So obviously, then these individual investors, they kind of stop their SIPs in that particular sector and start their SIPs in some different sector, which is becoming more talked about in the market. Do you believe, the question is, do you believe that should just be done or people should just continue on their asset allocation, what they decided and initially started with?
So then please appreciate that sectoral approaches are always cyclical in nature.
Yes.
It may function very well and then you would see that sector going absolutely unnoticed for like a couple of years.
Sure.
So what are you doing?
Yeah.
It's better that you take a diversified equity fund, wherein let the manager decide which sector is in the outlook and let the manager distribute the money in those sectors,
Sure.
and then your money continue growing. Cyclicalities are far lesser if you take a diversified funds vis-a-vis you take a sectoral fund. I really want to get your attention to something which is very, very, I would say innovative in mind to me, that you can actually decide an SIP and an SWP as a combination and can actually plan a retirement.
Of course.
So let me share some data with you, and that will help you understand what am I trying to say. I hope my screen is visible.
Yes, it is visible.
Okay. Now look at this. Can you see this?
Yes.
Okay, I'm taking an assumption of three investors, investor A, B, and a C. The first investor does SIP of 10,000 for 20 years. Second does it for 25, third does it for 30 years. Okay. I'm again assuming that a compounding CAGR over 20, 25, 30 years stays 12%. 10,000 is the amount that he has chosen to invest. So if I look at total amount that he has invested is 24 lakhs, 30 lakhs, and 36 lakhs, which at the end of SIP tenure, at the time of retirement, which is if he attains an age of 60, works out to 91 lakhs, 1 crore 70 and 3 odd crores. Okay. Now this is what he has accumulated. Now he has attained the age of 60. Now he would want to enjoy his retirement. So assuming he decides that, boss, I think 40,000 rupees is a decent amount of money for me to retire. Someone says, no, it should be 60. Someone says it's 80, depend because I have got a larger corpus.
Right.
So I can enjoy more. Assuming he lives another 25 years. Okay. And we further assume that inflation stays at say 5%. And what we are assuming that the money that he has acquired, that money in certain safe instrument is growing at say 8 odd percent. CAGR. Over next 25 years, 40,000 if he withdraws every month, he has withdrawn close to 2.29 crores. After withdrawing, he still is left with 55 lakhs. And if you go on a higher tenor, the guy who is on a 60,000 rupees, who has withdrawn close to 3.4 CR, is still sitting on 3 CR. On a 30-year, The guy, he's already taken 4.6 crores out of it, the system. It's still 9.5 crores stays. The point that I'm making is SIP is such a strong and a powerful tool. All that you need to do is to have a commitment of 20, 25, 30 years. And even if you take a systematic approach of withdrawing the money, that corpus itself continue to grow and yet is going to fund you for all your daily needs or recurring needs on a monthly basis.
This is very, very interesting.
So problem is that many of these things we do understand, we do acknowledge.
Right.
But when it comes to a time of pain, we just overlook all of this. The first thing that we want to look at doing is save capital, stop the SIP, redeem everything.
Very true.
And actually, SIP works just opposite to this behavior.
Very true.
The markets are falling, you must stay invested, because then only you will get the biggest contributor or the biggest, I would say, a notion for the SIP, which is dollar cost averaging. That feature works the best in the drawdown market times.
Absolutely. Absolutely.
So that's my submission, which is when I say SIP you cannot ignore.
Great. Perfect. Thanks. That was very, very interesting data on SIPs, then SWPs, post the retirement time. So, well, for our viewers, a very, very interesting conversation on a topic like systematic investment plan, and then an SWP as well, systematic withdrawal plan, with Mr. Anunaya Kumar, President, Head of Sales and Distributor, 361 Asset Management. Something, of course, we all know, but sometimes it's very important to, understand it once again, just to refresh our understanding so that we continue to be in the right path. So Anunaya, thank you very much for joining in today and taking us through this wonderful data and your valuable inputs as well.
Thank you. Thank you, Praveen.
Thank you very much.